Over the last 10-15 years or so, China's economy and monetary policy have had a massive impact on global economic activity, with China's credit impulse often leading by over 8 months. The global business cycle here represented in blue by the global manufacturing PMI. Now, more recently, we've also had the largest contraction in China's housing market in over a decade, and that has been despite the Chinese central bank's effort to try and ease monetary policy throughout 2023. As I'm going to show you in this video, there are other signs that the Chinese economy is weakening. We're going to take a look at those and understand how that weakness can have spillover effects onto the rest of the global economy, including the US, and of course what that means for investors. Welcome back to Game of Trades. I hope you guys are going to enjoy this video. If you do, don't forget to click on the like button and the subscribe button if you haven't already. Now, without further ado, let's get right into it. I'm going to start off this video by showing you how the Chinese central bank has actually been easing monetary policy, cutting interest rates. This is the one-year government bond yield in China. And despite these efforts, we continue to see signs of economic weakness in China. One of those being copper. The majority of demand for copper, the industrial metal, actually comes from China. So a weak copper means a weak China and a weak global economy. The same thing goes for Chinese stocks. This is FXI, the large cap China ETF. And you can see, despite the central bank's efforts to ease monetary policy, we've seen Chinese stocks actually continue to move down, continuing the bear market that began in 2021. PE ratios in China are actually right now extremely cheap relative to US ones. That's one of the things that we're currently looking into when it comes to China as an investment opportunity at gameoftrades.net. Buying stocks with historically cheap valuations is always one more thing that you can do to put the odds in your favor when it comes to making the right bets. But the fact that valuations are low right now in China means the market is very skeptical about the fact that the central bank is easing monetary policy enough. Now, more recently, you did see a little bit of a surge in Chinese bond yields, and that was actually the market getting optimistic about COVID restrictions getting lifted in 2022. If you were a member at gameoftrades.net, you'll know that that was one of our big trades in 2022. We added COPEX, copper miners, back in 2022 to the model portfolio, and it did see quite substantial gains. It was a very successful trade. We booked profits on it back in February when we started to focus on the idea that we were heading into a global economic recession, which is what's starting to get priced in, at least when you look at China, copper, Chinese stocks, but perhaps for now, less so in areas like the US stock market and the European stock market. By the way, if you're interested in these types of trades, go check out our website at gameoftrades.net. We walk you through our entire investment strategy, and we're extremely transparent about all the trades and our entire track record. Also, we will be raising our prices on July 10th quite substantially. We do believe that the quality of our research fits a higher price range, especially when we look at how cheap our research is relative to most of the competition out there. Now, as soon as you got that optimism out of the way, you can see Chinese bond yields rolled over and started to focus on the weakening economic backdrop again and began to price in additional rate cuts from the Chinese central bank. And really, none of this should come as a surprise. If we look at data from a research paper from the IMF, we see that credit stimulus actually doesn't help China's economy in any way. It used to be the case that credit stimulus would help the Chinese economy between around 2001 and 2008. But ever since the financial crisis, we see that credit stimulus doesn't do any good for economic growth in China. It's actually the fiscal stimulus that is likely to boost the Chinese economy. So really, until Chinese authorities step in with fiscal support, not just lowering the central bank's interest rate, but actual fiscal stimulus, until they do that, you're very likely to see the Chinese economic struggle continue and possibly even get worse. That's exactly why we've seen the housing slump in China actually continue, despite the fact that mortgage rates in China have been coming down throughout 2022 and 2023. Now, the question is, how does this impact the global economy? Now, as we discussed at the beginning of this video, there is a very tight correlation between China's economy and monetary policy and what the global economy is doing. And I can also show you that by looking at Chinese monetary policy against U.S. economic activity. This orange line here are U.S. manufacturing PMIs. And you can see a weakening China systematically leads to a weakening U.S. manufacturing sector. And you can say that's a pretty good representation of how the U.S. economy is doing. We saw that in 2018. We saw that in 2021, where the Chinese economy peaked in very early 2021, and the Chinese central bank actually began to ease monetary policy here throughout 2021 and 2022. As the Chinese economy was weakening, you had manufacturing PMIs in the U.S. roll over quite aggressively. We saw the same thing in 2014 here. Chinese economy weakening in 2014, 2015, eventually leading to pretty steep slowdown in the U.S. in 2015, 2016. Now, just looking at this chart, there's no real sign right now that China is experiencing this big economic recovery like we saw, for example, in 2020 here, like we saw in 2016 here, like we saw in 2009 here. That's not happening right now. In fact, evidence is pointing towards a weakening China, weakening stock market, weakening copper prices, and Chinese authorities not yet stepping in with fiscal support to create an economic boom. Now, if we use a 2020 paper from the Federal Reserve, they actually concluded that the euro area was a bigger tail risk to the U.S. economy than China. So if Europe has a slowdown, a recession, that's going to have a greater impact on the U.S. than if China has a slowdown, which is currently what's happening right now. But of course, what this chart doesn't show you is the impact that China has on Europe, which can then have an impact on the U.S. For example, if you take a look at Germany, which is a big exporter to China. In fact, Germany is one of the biggest global exporters to China. German imported goods into China have actually been very, very weak more recently, similar to what we saw in 2019, 2020, similar to what we saw in 2015 when China was slowing down, in 2009, when of course the entire global economy was in a recession. So weakening Chinese consumer is a problem for Germany. The global economy needs a strong China in order to thrive. In fact, if you look at the most recent euro area manufacturing PMIs, they're making new cycle lows every single month right now, deep in contraction territory to the deepest level since COVID, and before that, 2008. If we want to know the spillovers that we're going to see to the US, not only does China seem to be weak and struggling to make a sustained recovery, but Europe as well, and they're fighting the same inflation problem as the US. Now, if I add European stocks on top of the euro area manufacturing PMI, hopefully this is going to give you a sense for the risk reward of European stocks right now. We are seeing a pretty steep divergence between euro area manufacturing PMIs that are heading deep into contraction, right at 43.6. We say that PMIs are at break even at around 50. So we're well below that right now, and the European economy is heading deeper into contraction as we speak. Meanwhile, you see this ETF EZU actually making substantial gains over the past few months and almost recovering the entire 2022 bear market, with some European indices like the CAC 40 in France making new all-time highs. Usually, most of the time, the market is rational and trades in line with the underlying economy, as we've seen for the past 15 years. Right now, it does seem that European stocks are behaving irrationally. Now, the market can remain irrational for longer than you can remain solvent. So this is not a signal to short European stocks, but it does speak to the risk reward of going long here, as these stocks have posted incredible gains, but the underlying economy actually moving into a contraction. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to click on the like button down below and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading, and see you next time.